Hey guys, so a lot of stocks have been battered down. What do you do when the stocks that you own are down? What do you do when you see a lot of stocks? And of course, people think when they come into the stock market should always produce stocks that will always go up. The stock market should go up over time. But guess what? What do you do on a year where the stock market or the stocks that you're tracking are not going anywhere? They're battered down. They're going down. What if the stocks that you're owning are down as well? If you are into this and you want to know more, check this video out. Hi everyone, this is Marvin Gurmo. If you're new to this channel, please subscribe and smash that bell so you get updated every time I create new content about the stock market. I keep creating content like this so that I want you guys to win. I want you to be informed. I want you to know what you're getting into. But please remember this, there's no such thing as a perfect investment. There's no such thing as an investment that will give you guaranteed returns over a stretched period of time. There's no such thing as that. There will always be a risk to any investment that you come into. That's why this channel exists as a way for you to be educated on how you can navigate what's the risk and what's the reward of the stocks or whatever asset class you want to come into. So enjoy the rest of the video. So in this video, I want to focus on those who bought stocks that are dropping. As expected, there will be a lot of people who will be concerned when they see their stocks start to go down. So please remember this. I know how it feels. I know what it feels when you put, of course, it's still hard-earned money no matter how big it is, no matter we say that we only put money in the stock market that should be an excess. It's still an amount of money that you might have worked hard for from your job. This could have been your bonus. This could have been an amount of money you could have just placed in the bank or time deposits, and you still could have gotten a better yield, a better return. Or if you just bought bonds or preferred shares, you would have still gotten a better yield than putting it in a stock that's dropping. That's very, very understandable. Or you could have enjoyed it. You could have gone out, ate out. You could have traveled outside the country, and you would have enjoyed the money as well. And I know it's opportunity lost also when you see stocks that have dropped, that if you are owning them and you are an investor, you have to wait a longer period of time as well. So let me share this to all of you. One of the things that you could do when you see stocks that are down is, number one, you always have to go back to what your plan is. You always have to go back to the definition on why you came into the market. What's the main logic? What's the main rationale of you coming in? It always boils back to your financial planning, meaning if the money that you're placing in the stock market is not something you plan to touch for a very, very long period of time, meaning when I started out investing, I started out in my early 20s, and my main goal, my main narrative was basically this. I just wanted to put my money that when I would retire, at that time, that was what I was thinking. When I would retire at 60 years old, I have something that I could use. And that was my main concept. And I was thinking that if I was 21, 22 years old, and then a recession would happen when I hit 35, or something bad would happen when I hit 35 years old. I was thinking that, I'm 35, I need the money at 60 years old. I don't need the money yet, so I don't need to panic. I don't need to be scared, because at the end of the day, as long as I buy good companies, I know they will always come back. So from a financial planning perspective, when you see stocks drop on year 1, 2, 3, 4, 5, 6, 7, and your timeline is very, very long, go back to that. Go back to your anchor, that if you don't need the money yet, you should not be scared. If you don't need the money yet, you can sit put. Noting, please remember this, it will always go back. If you own mutual funds, then it's okay. You can sit tight, you can just hold, and you can just wait. Because you have fund managers whose sole responsibility is basically to buy and sell and hold and analyze where they're supposed to allocate. So if you're buying individual stocks, you're like me, you are a stock investor, you're a stock trader, your main narrative basically is this. You better make sure what the stocks that you've bought are fundamentally sound. You better make sure that the stocks that you've bought still have good opportunities for growth. You better make sure that the stocks that you bought would give out good dividends as well. Because while they are down, at least if they have dividends, you get a rate of return. If the company is good and growing while they're down, you have this narrative that if you have extra cash, you can add some more. You have this narrative also that you can still sleep well at night. Why? Because you know, because the company is good, they'll still thrive. You know, because the company is still good, there's nothing for you to be worried about. You know, because the company is good, you could still probably hold them over stretch period of time. So if you are an investor, when I say you are an investor, you initially set out to be an investor. That's your goal. Hindi yung trader then naipit naging investor na lang. That's wrong also. It's okay to be an investor if you set out to be an investor. If you are an investor because naipit, then that's you not following your plan. That's you not following what your trading plan is. And I'd rather lose money from trading if my goal is to cut loss on a certain stock as well. So again, let's try to break it down. If you are an investor, the fundamentals of the company that you're buying is good, by all means hold. But not just that, if you have cash and you know how to use valuation models and you see at that point in time it becomes cheaper, boom, put in more money. Or if you know how to use technicals, as a stock started to drop, it hits a large level of support and consolidates there. Boom, put in some more also if you're an investor. Next, if you're also an investor and your main narrative for buying basically are dividend yields, then the next thing that you could possibly do is this. When the dividend yields are already attractive, then by all means, buy it as much as you can and hold and let the gains grow for you over a long period of time. That's how money is also made, by sticking to stocks that have dropped and will give you significant dividends. Because as long as the company is good, please remember, it will always go back to the concept that as long as the company is good, if it's not good anymore, or you bought a basura stock, and that basura stock is not making money, that basura stock went up because there was news only, then after the news is gone, the stock is down, and it continues to go down, you better make sure you get out. I'm not here to tell you that you hold on to stocks that are losing. When I say losing, it's not just that the price are going down, it's also that there's nothing in it that will cause it to reverse later on. Please remember, what causes companies to reverse is that the fundamentals of the companies are amazing. I repeat, what causes companies to reverse is that the fundamentals of the company is amazing. The valuations make it so cheap, or the dividends make it so attractive that people start to buy it already. It doesn't make sense that it's not bought because the dividends alone that you will get is way attractive already. So that's your goal. If you're a person who wants to buy it for a stretch period of time, you are a person who's very, 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 very passive. Or for those who read my book, Stress-Free Investing, link is in the description below where you can order it via Shopee. I mentioned that the only time you have to transact is when your reallocation date happens, when your rebalancing date happens. Meaning, if your rebalancing date is at the end of the year, then that's when you take action, whether you pull out a stock, transfer it, rebalance, add some more to that stock. But in between, if you're not supposed to rebalance this December, then you don't need to do anything as well. Now, if you're a peso cost averaging type of person, full disclosure, I do not do peso cost averaging, but I know there's a big chunk of you who would do peso cost averaging. There's a big chunk of you also who love doing peso cost averaging. Please remember this. If the fundamentals is not there anymore on a stock that you are doing peso cost averaging on, get out, sell. I repeat, if the fundamentals is no longer there on a stock that you are doing peso cost averaging on, get out, sell. But if the fundamentals of the company that you want, I assume that since you're doing peso cost averaging in this now, you are an investor, but not just that, you know that the company that you are buying is growing. Because if the company that you are buying is not growing, that doesn't make sense to hold on to it for a very, very long period of time. It doesn't make sense that you do peso cost averaging on it also. If the company is not growing, it will go back to the context, it will go back to the main narrative that it has to be a company that's good, it has to be a company that's growing. And because money comes into you, you're employed, you have commission, you're commission based, and money comes in on a regular period of time, that's when you keep on adding. As long as it's good, as long as the company's fundamentals are there as well. Now, why am I saying this? When a stock is dropping because of what's happening, and you are a peso cost averaging type of investor, isn't that what you want? You want to buy a stock that's cheap. You want to buy a stock that's low. You want to buy a stock that no one else wants. So that now when you're doing peso cost, as the stock is dropping, as the stock is low, you get to buy them at a very, very low price. And not just that, you get to buy more shares. You get to allocate and you get to position. So that later on, when it becomes expensive already, you have a lot already, you were able to position and get a lot as well. And I keep saying this, the whole reason why you do peso cost averaging is basically, number one, so that you don't become emotional. The stock is down, you still buy. The stock is up, you still buy. But since you are a peso cost average and the stock is down now, you're supposed to buy still. Disregard the emotion, disregard the fear, disregard what everyone else is telling you, disregard what people are saying, that there might be a recession tomorrow. Guess what? We don't know when a recession will happen. What I do know is a recession will come. All you can do is be prepared for it. But as long as you know what you're buying is good, continue. Stick to your plan. Plow in. Put it in. Put that amount of money in a company that's doing good, doing well, especially if your timeline is long. Please remember this, peso cost averaging does not work if your timeline is 1 year. If your timeline is 2 years, peso cost averaging does not work. If your timeline is 1 year, 2 years, better trade. You better come in, come out, follow those uptrends, follow those, stay away from those downtrends, trade those sideways markets. If your duration is very, very short, you better trade, you better trade, you better trade. If your duration is long, that's when peso cost averaging works. So if you're frustrated that, it's not working for me, I'm doing peso cost averaging already for a year, guess what? That's not the whole context of peso cost averaging. Peso cost averaging is not meant for you to invest in if you're just investing in it for the short term. Peso cost averaging is long-term accumulation, but by the time you need it already later on, because you did your job, you did your due diligence, you started to plow, you started to put in as much as you can, 10, 20, 30 years after, that position that you placed in should have already done a good amount of money. So, my recommendation, if you're doing peso cost, assuming that the fundamentals of the company that you are watching did not change at all, by all means, just continue. Put in as much as you can. But if the fundamentals have changed, sell. Sell everything. Sell everything. Sell everything. And transfer it to another stock. When I say sell everything, don't take out the cash and spend it on something that you don't need. The whole goal, the whole narrative of this is you sell and you transfer it to another stock that will give you a better chance of upside later on. Lastly, if you're a trader, I've been making so many videos about trading. The whole context of trading basically is you rely on technical analysis for you to be able to win. You rely on technical analysis for you to be able to buy, sell, buy, sell, buy, sell, buy, sell, buy, sell. You rely on technical analysis to follow what the charts are telling you over a stretched period of time. Why am I saying this? Why is this important? Why is this significant? If a stock that you bought is breaking down, by all means, sell. I repeat, do not average down on a stock that's breaking down if you're a trader. Do not average down on a stock that's breaking down if you're a trader. Cut loss, saluhin mo, if it comes back to the previous support, buy there, or transfer to another stock, or if it drops to a lower support, buy there and make the previous resistance your target price. It takes guts to be able to do it because it's every time you sell, that's when you actualize your losses. Every time you sell, that's when you're saying goodbye to a piece of money already that should have been yours or should have given you an upside. That's why you only expose yourself to an amount of money for a particular stock that you are willing to lose. Either you cut loss into it, or if you're an investor, you're willing to hold that it doesn't go anywhere for a very, 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 very long period of time. And by the way, I've been saying this in a lot of videos, the biggest advantage of the stock market as compared to investing in startups, sa startup, pwede mo lang yung pera eh. It can go to zero eh. The company can close down easily because it's not yet a big company, because the company does not have yet a revenue model that's giving them passive income, that's giving them, they're not yet the market leader in their category. In the stock market, if the price is battered, guess what? As long as the company is still doing well, you're still supposed to do well. Next, if you're a trader, and you are a position type of trader, meaning you follow the trend, if the entire market is down, but the stock that you own is still in an uptrend, you hold. You don't have to sell. You don't have to panic. You ride the trend to the fullness of where it is. You ride that trend up until you see a reversal happen. And I've been saying this over and over and over and over. A stock will continue to be an uptrend until proven otherwise. Meaning, until a reversal pattern would come out, you hold. You don't have to do anything for the stock yet. And if you see a stock that's in a downtrend, guess what? No matter how cheap it looks and you're a position trader, avoid. No matter how appealing the name of the company is and you're a position trader and the stock is still in a downtrend, avoid. For those of you who are thinking, what are this all jargons? I have so many videos about technical analysis, or you can check out the link in Shopee for the books that I created. All of them have technical analysis as well. But anyways, if a stock is in a downtrend, you're a position trader, you own the stock, my highest suggestion is if it's just starting in its downtrend, better sell. It's not worth holding a stock in a downtrend if you are a trader. Please remember, I'll keep saying this. The term downtrend is should be used for people who are trading. If you're investing, focus more on the valuations. You have to know that if it's in a downtrend, you are an investor, you just have to slug it out. You just have to follow what your plan is, what your signal is via fundamentals to sell the stock. If the fundamentals did not change, you hold your position. Now back to downtrends. So if the stock is in a downtrend, just hold. You don't just stay away from the stock. When the stock is in a downtrend, stay away from the stock if you're a trader. If you own the stock, better get out, especially if it's early. But please remember this, the best time for you to be able to escape, the best time for you to be able to get out of that position is basically when the stock is breaking down. You will incur a loss, but please remember this, every time you come into the stock market, you must realize that losses are part of the game. Every time you come into the stock market, you must realize that there's a possibility that it won't be weeks, months that you will always earn. That's why it's very, very important that you prepare yourself also mentally that what if it happens that you have streaks of weeks and months that you are not making money or the stock market is in a downtrend. And that's the strength of technical analysis. If a stock or a market is particularly in a downtrend, you just avoid. And you have to make sure that's why I keep hammering, if you are a stock investor, you need to have stocks that give you dividends, because while a lot of the stocks are in a downtrend, because you have stocks that give you dividends, you have cash flow, you have money to live with, you have something that you can use for your day-to-day life as well. So there, and just to end, no, stay away from your emotions. It's your emotions that will kill you. It's your emotions that will make you lose. It's your emotions that will make you decide to do other things that you're not supposed to do. It's your emotions that will push you to do other things that's not as fruitful. And I've seen it over and over and over, regardless of how long the people are in the market already. It's still emotion. So your goal here is to follow. Think about, what's my financial plan? How long am I in the market? How long do I need the money? What's my trading plan? Am I an investor, a position trader, or a quick trader? What are my parameters to sell? If your parameters to sell have been hit, sell. If your parameters to sell have not been hit, hold. But never buy, never sell just because of emotions. And I keep saying this over and over, because the stock market is not just about technique, it's not just about skill, it's not just about planning, it's also about winning against your emotions. And that's all I want. I just want you guys to win. No hidden agenda. That's the reason why, even though it's hard to make videos like this over and over, it's hard to make daily videos about the stock market, but it's something that I love. It's something that makes me feel alive, and it's something that I want to impart to you, that if there's something that you believe you're on a mission to do, just keep on doing it, no matter how hard it is. And my mission really is just to educate this generation, the greatest generation alive, to be able to be one of the richest generations alive. Because as we become the richest generation alive, we will have the ability to help other people as well. So I hope to see you, final event for the year, December 14, SMX Aura. Link is in the description for those who want to join us. And then the next Stock Smart sessions, I'll announce it already. Taiwan, February 15. Stock Smarts Manila will resume March. Then we will have Stock Smart Singapore this May. I'll let you know if we're gonna have Stock Smarts in New Zealand and London. I'm trying to make sure it will happen. Then we're gonna have Doha and Dubai as well for 2020. So I guess that's it for now. Marvin Germo, we're just a few days before Christmas. What's your gift to yourself this Christmas? I want to know. Comment it in the description below. Hindi lang dapat din para puro stock market pinag-usapan natin, but since I've been sharing portions of my life as well, comment something about you and what you want to do with the money that you have this Christmas. So that's it for now. This is Marvin Germo. I hope this video helps you trade well, trade strong, trade smart. See you all again soon, guys, and God bless you all.